What's up, you Graham? It's here, guys, and I hope you're prepared for what's about to happen in 2025. Despite the market rallying on a Trump election, tariff delays, and a variety of executive orders soon going into effect, as of a few hours ago, the Federal Reserve once again decided to pause any interest rate cuts for the foreseeable future. Except this time, there's no going back. For instance, Jerome Powell has just signaled that they intend to keep interest rates higher for longer, putting him on a potential collision course with Trump. Experts are now warning that the AI bubble could soon be over, and lately there are more and more warnings about the mother of all bubbles popping, with market euphoria and speculation going absolutely wild. So with some rather significant changes soon going into effect, we gotta discuss exactly what's happening, how a Trump economy is going to affect 2025, the impact this is likely to have on everything from stocks to real estate to cryptocurrency, and then most importantly, how you could use this information to either make or save yourselves as much money as possible. Although really quick, before we start, if you appreciate the last minute updates like this, it would mean the world to me if you just hit the like button or subscribed. It's totally free, it takes you a split second, and as a thank you for doing that, I'll do my best to respond to as many comments as I can. So thanks so much, and also a big thank you to Surfshark VPN for sponsoring this video, but more on that later. Alright, so in terms of why the Federal Reserve is choosing to pause rates throughout the beginning of 2025, we need to talk about the one term that sends chills down every investor's spine, the boogeyman of inflation. Okay, I know that sounds a bit confusing, but all you need to know is this. We have two different kinds of inflation. One measures the price of everything, known as CPI, and the other excludes more volatile categories like food and energy, because those could rise and fall depending on the season. And in terms of everything, prices did end up actually going a little higher. In this case, prices moved from a 2.7% increase in November to a 2.9% increase in December, driven higher by rising grocery costs, or mainly eggs, which have seen a 37% increase since 2023. Gasoline prices are also up 4.4% from a month ago, and housing is up 4.6% from this time last year, which brought up the average and gives us this 2.9% headline increase that we see here. However, if we just ignore the cost of groceries and eggs and gasoline, our core inflation actually decreased from 3.3% in November to 3.2% in December, giving some hope that inflation is beginning to make some progress. But, honestly, the good news somewhat ends there. Even though prices are starting to come down from their peak in 2022, the average worker's earnings are still not keeping up with the pace of inflation, rising just 1% from the year prior. This means if you now make 1% more than you did before, but prices are 3% higher than they were before, congratulations, you are now effectively taking home 2% less. However, now that Trump is back in office, there are some major changes that could soon go into effect that could theoretically save you a lot of money, and that's what brings us to the Trump tax cuts. Now, in terms of these proposed changes, number one, all the 2017 tax cuts will be made permanent. This means the top tax bracket is going to remain at 37% instead of the previous 39.6%. Those amounts would more or less be adjusted to inflation every year, and we're probably going to get more of the same to what we're already accustomed to. Second, Trump is aiming to lower the corporate income tax rate from 20% where it is now down to 15%. This one is admittedly fairly significant because it would be substantially lower than where it was back in 2016, which was at 35%. Third, there are proposed tariffs on imports. The thinking here is that this would encourage more production within the United States. The revenue generated from this would more than offset the tax cuts to American citizens, and our economy would thrive. But critics to this say that this would just end up with higher prices for American people. Other countries could retaliate with their own tariffs. American companies would bear the brunt of these import fees, and this would likely just offset all the money being saved elsewhere. But we'll see. Fourth, overtime pay and tips would be exempt from federal tax. To me, I think this is a huge opportunity for workers to increase their take-home pay, but I also can't help but feel like this could also be perfect for certain people and employers to abuse. So we're probably going to have to wait and see for specific instructions on how this will work. Otherwise, it could be an all-out cash grab. Fifth, he could propose to end tax on all Social Security income. Now, I think this one could be pretty substantial for current retirees, but critics of this warn that it puts a strain on a very delicate tax system to begin with. It drains the Social Security fund more than where it's currently at, and it predominantly benefits people who already have a high income to begin with. Although I also think that could lead to a lot more discretionary income within our economy, which is a good thing. So again, we're gonna have to wait and see what happens here. After that, 6, estate tax cuts would be made permanent, which means a married couple would have up to $28 million of exclusion on inheritances. But since this probably only impacts like 1 or 2 people watching this video, we'll move on to the next one, which would be number 7, raising or ending the SALT cap deduction. For those unaware, this capped the state and local tax deduction at $10,000 against your federal income taxes. So if you pay any more than that in state taxes or property taxes, you're probably missing out on some pretty substantial savings and write-offs. And finally, 8th, clean energy tax cuts would be eliminated and no longer providing a financial bonus for buying EVs or Teslas. Now, even though this list is quite comprehensive, realistically, not all of it's going to pass, and even more realistically, we're probably just going to see a watered-down version of all of this by the time it goes into effect. Anyway, in terms of what this means for the stock market and housing prices in 2025, you're going to want to listen to this, because here's where things get crazy. Although before we go into the exact numbers, here's the thing. What good is growing your wealth if you're not going to protect it? Like, in today's day and age, privacy and online security are just as valuable as any investment, and that, of course, is where our sponsor, Surfshark VPN, wants to help. For those unaware, Surfshark VPN works by encrypting your online data to help secure your personal information, mask your IP address, and prevent hackers from identifying your city, county, and download history. Or basically, a VPN works by swapping the real location of your device with a new one, giving you the ability to virtually travel anywhere around the globe. Not to mention, it's also really useful anytime you connect to public Wi-Fi, which could be a goldmine for hackers. Or if you sign up for random online services, Surfshark VPN allows you to use an alternative email generator so that you don't have to give out your actual information. On top of that, Surfshark's Clean Web feature blocks ads, tracking, malware, and phishing attempts, allowing you to surf the web safely. Plus, they don't track, store, or monitor what you do online, so there's no connection or activity logs. In terms of how important this is, I use a VPN anytime I travel. If I'm out of the country, I could switch my location back to the United States so everything functions as normal. Or if you're in the mood to watch something that's not available in the United States, switch the location to something like the United Kingdom, where you could watch Rick and Morty or The Office on Netflix. So if you're interested, click the link down below in the description or go to surfshark.com/Graham to get an extra 4 months for free. They also offer a risk-free 30-day money-back guarantee if you're not completely satisfied, so there's no risk. The link is down below in the description to get started. Thank you so much, and now let's get back to the video. Alright, now before we talk about Jerome Powell's latest statements and plans for 2025, we need to talk about what's happening with the stock market. First of all, it's no surprise that 2024 was an absolutely phenomenal, somewhat record-breaking year for stocks, with the S&P 500 rising by more than 23% after 2023's returns coming in at a whopping 26%. But in terms of this year, the results, according to analysts, are somewhat mixed. See, as of lately, only 28% of stocks within the S&P 500 are beating the index, meaning the vast majority of profits are simply coming from the largest 7 companies that are doing incredibly well, and that would be Google, Apple, Amazon, Meta, Microsoft, Nvidia, and Tesla. And this type of concentration really hasn't been seen before since 1998 and 1999, right before the dot-com bubble. On top of that, many investors are beginning to worry that the artificial intelligence momentum is officially over now that DeepSeek is theoretically able to operate on a fraction of what we've been using here in the United States, causing the entire market to begin selling off in a panic. Now, if you believe DeepSeek in China, then yeah, perhaps the market is a bit overinflated and needs to adjust. But if you don't believe them, then time will tell. Anyway, in terms of whether or not we're going to see a significant market correction this year, the answer is, as of now, probably not, at least according to the experts. For example, Goldman Sachs projects the S&P 500 to end this year at 6,500, which would be a 10% increase at today's levels, including dividends. Other firms also agree with this, including Morgan Stanley and JP Morgan Chase, and Oppenheimer came in with the most bullish case, believing the market could rise another 20% by the end of December. In terms of why, it's said the proposals to lower corporate taxes and ease regulation are seen by many investors as easy to put in place and broadly positive for company profits in the stock market. On top of that, it's said that some analysts see U.S. stocks' impressive growth as evidence of a new era in tech and AI, with sustainable valuations and strong future earnings growth to support a continued rally. Of course, there is the worry that tariffs could put a damper on the economy and cause prices to rise, but others say that I don't think tariffs will be as severe. The bark will be worse than the bite. Although keep in mind, when it came to stocks in 2024, every single analyst prediction was wrong, and even the most bullish cases didn't even predict half of what we wound up seeing. In fact, over the past 25 years, 53% of almost 400 firm forecasts surveyed by Bloomberg clustered between 0 and 10%. So basically, everyone is playing it very safe, guessing very average returns, and then hoping they're not wrong by the time the actual numbers come out. Thankfully though, despite the experts having absolutely no idea what's going to happen, historically, when the S&P 500 climbs 2 years straight, it rises the next year 71% of the time. The average third-year return is 9.4%, and when the S&P 500 rallies 20% or more 2 years in a row, as it did in 2023 and 24, the index goes up the following year 67% of the time, and the average third-year return is 7%. So overall, according to the past data, things do look pretty good, but it's worth being reminded that it can be a good idea sometimes to also play it safe, and that anything can happen when you least expect it, especially when it comes to something like the housing market. Look, it's no surprise, despite national mortgage rates remaining above 7%, housing prices in 2024 have defied the odds, having increased by an average of 3.4%. But in terms of what's happening in 2025, you better get ready. The top 10 metros saw average gains of 1.9 to 5.8%, with the highest returns coming from Miami and Chicago. Meanwhile, the worst markets saw average declines of 3.5 to 2%, including Wyoming, Idaho, Washington, and Hawaii. And in terms of where they think the market's going to go throughout the rest of the year, their answer is really more of the same, with another 3.8% increase over the next 12 months. Although Zillow has a few extra details about 2025 that are absolutely worth mentioning. They think the housing market's going to see an average increase of 2.6% this year, which is basically the rate of inflation, and that buyers will begin to have the upper hand as more inventory gets listed on the market. They also believe that mortgage rates will remain volatile, but on the high side, and that more buyers are going to relocate to the Southwest, where affordability is, I guess, more affordable. Anyway, with prices and mortgage rates as high as they are, smaller homes might start to see more demand as they become cheaper when you compare them to larger homes, and rents may finally begin to creep back up as the multifamily construction boom is pretty much over. However, over the next 5 years, most experts seem to think that we're probably just going to get more of the same, with elevated mortgage rates and high prices, unless of course we see a massive recession which forces the Federal Reserve to lower rates back down to where they were in 2020. After all, single-family home construction never really recovered after the 2007 Great Financial Crisis, so there's probably going to be a shortage of inventory for quite some time, and we may never get back to the levels that we saw about 20 years ago, which, by the way, it's kind of crazy that 2005 is now 20 years ago. What happened? Where did the time go? Tell me. That is so trippy. I'm getting old. Okay, back on topic. From now until 2030, it's predicted that housing prices are simply going to rise just beyond the rate of inflation as they have been over the last century. And that also means that the more money gets printed into our economy, the higher the price that most assets are going to be rising. All of that is to say that, unfortunately, we're probably not going to see housing affordability improve over the next few years, and that even though more inventory may come on the market, it's probably not going to be enough to put a dent in prices. Although in terms of what Jerome Powell has to say about all of this and his plan for 2025, here is what you came for. As of a few hours ago, Jerome Powell signaled that they intend to pause any interest rate cuts for the beginning of 2025. And the most likely scenario so far is that we just get 2 25 basis point rate cuts by the end of the year, and that's it. After all, the way they see it, we are still above their 2% inflation target. Asset prices have not fallen whatsoever, and the unemployment rate is still fairly low, all things considered. So for them, there's very little risk in keeping interest rates somewhat elevated where they are right now, and then lowering them if needed in the event our economy needs a bit of a boost. Not to mention, they've also removed language this morning about making progress on inflation, which isn't exactly great for the markets, because if inflation remains elevated, you know what else remains elevated? Interest rates. Now, some people think that Trump might try to pressure Jerome Powell into lowering interest rates prematurely as a way to boost up asset prices, and that's something certainly worth considering, especially because this happened back in 2018 once the market began to fall. But up until now, there's really no indication that this is going to be the case, and it's really up to us just to wait and see what ends up happening. Besides that, though, Jerome Powell really just gave us more of the same today, implying that they're going to be very cautious, only lower interest rates if absolutely needed, and respond to the labor labor market in the event we start to see unemployment spike higher. This is why if everything stays the status quo, most likely we're just going to get 1 or 2 small rate cuts in 2025, and that's it, pending a absurd black swan event that nobody sees coming, which is a possibility. You never know. But as of now, it's looking like rates are going to be staying a bit higher than most people wanted them to. No, this isn't exactly bullish for the stock market, but it does give the Federal Reserve a lot of optionality to lower rates if they absolutely have to. Now, as far as my own thoughts about everything that's just happened, it seems like earnings growth is strong for stocks. Most of our economy has adjusted to higher interest rates without completely destroying our portfolios, and the biggest risk is simply what happens if everything goes wrong. Like, to me, the biggest what if just has to do with tariffs. I mean, there is a situation in which Trump negotiates too hard, other countries retaliate, we find ourselves in a trade war, prices spike to unsustainable levels, and the stock market begins to sell off. It's not impossible, and there could be some rather serious consequences if things go wrong. But there is also a chance that he doesn't put as much pressure as we expect. The United States saves a lot of money and flourishes, and everything turns out great. We just have no idea. Or DeepSeek completely collapses the artificial intelligence premium pricing in the market, causing stocks to begin selling off into the abyss. But then again, what do I know? This is why I'm playing it optimistically cautious. Like, I'm still keeping an emergency fund on the sidelines just in case, but I'm still buying in on a regular basis and continuing to invest, and that way I don't miss out on any of the upside. As an example of this, just take the research from the Wealth of Common Sense blog. They found that historically, over a 20-year term, everything so far has been profitable, and over a 30-year term, the market has not returned less than 8% a year. On top of that, they've also found that since the 1950s, we have spent less and less time in a recession or a bear market. So that's just a little piece of information to keep at the back of your mind. Essentially, everything that's happening today is somewhat of uncharted territory, and that's why it's always a good idea to save as much money as you can, continue investing as normal through the ups and the downs, and no matter what, hit the like button and subscribe if you have not done that already. So with that said, thank you so much for watching. It really means a lot, and until next time.